This is Alan Bush with the Daily Financial Futures Comment for Tuesday, August 25th. Starting out with the stock index futures, we are seeing prices sharply higher today with a very substantial rebound from all of the pressure that we did see yesterday. The reason for the recovery is primarily, or I would have to say almost entirely, due to news that the People's Bank of China announced their fifth interest rate cuts since November of last year. In addition, the People's Bank of China reduced the reserve ratio requirement, also a very stimulative effort. So good gains in stock index futures with the Bank of China easing credit conditions. Also, I think this is just the first salvo in a series of moves by central banks around the world to add more liquidity to their banking systems. Last week there were comments that the Bank of Japan was talking about more stimulus. I think that those central banks that are hawkish, such as the Fed and the Bank of England, are likely to back off of their hawkishness in light of recent economic developments, including the severe global break in stock indices over the last couple of days. Of course, not today with that big rebound. So whatever problems come our way, whether they're a stock index severe break or geopolitical problems, the major central banks around the world have enough ammunition to add more stimulus to the point where there will be a recovery in stock indices. Also, I do not think yesterday's decline is the beginning of any new major bear market, that with central banks still having plenty left as far as easing capabilities, that stock index futures will remain well supported on any type of break, including the severe break that we saw yesterday. Over in the foreign currencies, the dollar index was sharply lower yesterday on ideas that the Fed will be very reluctant, or should be reluctant, to raise interest rates in light of a new problem for them. In fact, a new global problem with the equity breakdown yesterday. Today, the dollar index partially recovering as stock index futures advancing this morning. Longer term, we feel that the dollar index will probably work lower as interest rate differentials appear to be turning against the U.S. dollar. Also, we have the euro currency lower today, even though we did have some better economic numbers out of Germany, and flight to quality longs being liquidated in the yen in light of better equity markets. And the commodity currencies, the Canadian dollar, the Australian dollar, better with energy prices firming. Over in the interest rate markets, these markets also very much being dominated by what the People's Bank of China did in the overnight session with their rather aggressive easing. So flight to quality longs being liquidated after 4 days of higher prices for futures. Today we are sharply lower, especially at the long end. Also still believing that the Fed will not be able to raise interest rates anytime soon. In fact, the probability of a rate increase at the September meeting is now down to 24%, and that is lower from yesterday. Also, a rate increase probability for the December meeting now under 50%, coming in at 49%. It was a bit higher yesterday, so the Fed very much likely to delay a rate increase, even though we did have one Fed governor yesterday indicating that a rate increase still is possible before the end of the year. More and more analysts are thinking that there will not be a rate increase this year. In fact, there is a very small minority of analysts and commentators talking about the possibility of QE4. Now, I want to stress that there is a very small group of people, but there is some talk of the possibility down the road of another quantitative easing from the Federal Reserve. So, good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.